This is your tech news briefing for Thursday, June 30th. I'm Julie Chang for The Wall Street Journal, filling in for Zoe Thomas. Celsius, one of the largest crypto lenders, has been under watchful eyes from investors in recent weeks. In mid-June, it said it was freezing all withdrawals, swaps, and transfers between accounts for its more than 1.5 million users, citing extreme market conditions. And last week, it hired restructuring attorneys for a potential bankruptcy filing. Celsius had pitched itself as less risky than a bank and even said it could offer better returns. But according to investor documents from 2021 reviewed by The Wall Street Journal, the lender had little cushion in the event of a downturn or mass withdrawals. As of last summer, it had $19 billion in assets and about $1 billion in equity. By comparison, North American banks in the S&P 1500 Composite Index typically have a median assets-to-equity ratio of less than half that, according to data from FactSet. Here to tell us more about the latest insights into Celsius's business is our reporter, Eliot Brown. Hi, Eliot. Thanks for coming on the show.
Thanks for having me.
So, Eliot, can you start us off by telling us about how Celsius, its CEO or the company, pitched itself to the crypto market?
Celsius was one of the sort of higher yield crypto platforms out there. So what that means is they were basically saying, anyone who has crypto, you can sort of store your money with us like a bank, and then we'll give you really high interest rates. And the reason that we can give you these high interest rates is because we're passing along all the profits that we get from business that we do, and we're giving them to you, whereas a bank just keeps your profits and gives them to fat cat executives. So that was essentially the pitch.
Okay, so that's how Celsius presented itself to potential customers. But you've been looking at investor documents. What did you find?
Yeah, so we got a hold of essentially what they were offering to investors in the company itself, which is different from sort of depositors who gave crypto to Celsius. And those basically paint a picture that Celsius was this really high-risk, highly leveraged bank with very little cushion in case something went wrong. And those are sort of the recipes for all the reasons that banks have regulations, because if a bank is going to be storing your money and giving you interest, if you want to withdraw your money, then it's really important that the bank can do that. And of course, what's happened with Celsius is, in mid-June, they froze withdrawals because they were unable to give people the money that they wanted back. So people gave them money and then they couldn't get it back. And so that's the essential problem that they have, presumably because some of these risks played a role, though we don't have the specifics on that.
And what has Celsius said about all of this?
Celsius has been relatively mum. They basically said that, in mid-June, they said that they were freezing withdrawals because of extreme market conditions, and otherwise they didn't comment to us for the story and have stopped really communicating. And the Journal has reported that they've hired advisors to advise on a potential bankruptcy filing, so we know things aren't going great over there.
You mentioned that Celsius didn't have a lot of money sloshing around, but it had a cushion. As you've said, it was holding on to a lot of money from crypto investors. So where did all of that go?
So basically, Celsius did have a business model akin to a bank, which is when a bank takes your money and you deposit it, that bank is usually taking that money and it doesn't just keep it in a vault ready to hand you back bags of cash. It goes and then gives people small business loans or gives people mortgages. So what Celsius was doing is, whereas a bank might have relatively stable loans that it's doing to make money for most of its funding, Celsius was lending to a whole bunch of other financial firms in the crypto sector. And so crypto is considered just this incredibly high risk product or area to lend. And that's where some huge portion of Celsius's deposits were going to invest or lend to other things in crypto land. And that also included they invested in their own Bitcoin mining operation. And so if you deposited money with them, then they're taking that money and essentially buying servers to mine Bitcoin, which is kind of hard to then immediately give you your money back if you want it back the next day.
Do you have a sense for when things started to go wrong for Celsius? Was there one moment that was just the turning point for it?
With them, we don't, because it was a pretty binary thing. It was, from what we've seen publicly, it was pretty binary. There wasn't enough money. They weren't able to fulfill enough requests to take money out. Then they said, we're freezing withdrawals. Now, generally in crypto land, what's been happening is in the past number of months, the declining value of all cryptocurrencies has led to, so far it seems to be this kind of slow one domino to the next. Maybe that's not the best analogy, but clearly there's some connection. When Bitcoin goes down by 60%, 70%, then people who had investments in that, and those investments were sort of tied to other investments, there gets to be this effect that, spreads from one to the other.
So it's that effect what's referred to as contagion in the crypto sector?
Yeah, so I think the big fear right now is much like we saw in the 2008 financial crisis when Lehman failed and then we all thought that, Merrill Lynch could fail and one bank failing was going to lead to another because one bank lent to the other and other people then, their loans went to zero and then nobody had enough money kind of riding around and the government had to step in. I think that's a fear of what could happen here.
All right. That was our reporter, Eliot Brown. Eliot, thanks again for being here.
Thanks for having me.
And that's it for today's Tech News Briefing. If you want more tech stories, check out our website, WSJ.com. And if you like our show, please rate and review it. You can do that wherever you get your podcasts. I'm Julie Chang for The Wall Street Journal. Thanks for listening.